Okay, so let's turn now to our true potential fund range and the investment outlook from each of our manager partners. What I'm going to do is I'm going to start off with SEI. So SEI have had a very positive view on the US election result and feel that Donald Trump is pro the consumer, and markets actually now have more clarity as to how the US will move forward. SEI feel that a reduction in corporate tax could be a big benefit for US stocks. They quoted their own company, SEI, they currently pay 36% corporate tax. So if Donald Trump could reduce that down to 20%, that would be a huge benefit. They are constructive on developed markets in general, feeling that global markets tend to move in tandem with the US, leading the way for other markets to follow. Contrary to some of our other managers, SEI do not feel that volatility levels will spike up under Donald Trump's leadership. Okay, so next let's take a look at Threadneedle. So starting with equities, the fund was around about 70% in FTSE 100 stocks, but some profits have been taken since the post-Brexit rally. And Threadneedle, I'm looking more towards the domestic cyclical companies. They've got zero weighting in both banks and miners. However, this isn't a structural long-term view, and they would add to these areas if they were to see value. They've been looking at stocks, UK banks such as Lloyds and Standard Chartered, but they're wary that there could be more bad news coming from these two companies. Threadneedle are a little bit more bearish on bonds and feel that the overall trend for bonds is one of rising yields. They're positioned quite conservatively when it comes to duration, so how sensitive they are to changes in interest rates. Threadneedle are very cognizant of investing for the long term and will not make any short-term changes due to short-term volatility. Okay, so let's move on to Close Brothers. Close have become more positive on equities and they feel like there's some really good opportunities within equity markets moving forward. They're still heavily underweight alternatives. They've only got about 1 to 2% in gold right now. They've been looking on bond markets and they've been focusing on reducing duration. So basically they're trying to get their bond portfolios less sensitive to movements in interest rates. Cash has been building up on the portfolios and they've been purchasing some short-term gilts as a way to store that cash but to still give you some return. Looking at sectors, they feel banks could be a beneficiary of potentially rising interest rates in the US. A lot of work's been carried out in the banking sector, but again, they're still lacking conviction across any region. Okay, so let's move on to have a look at the True Potential Allianz fund range. Positioning-wise, they're underweight gilts and bonds, overweight US, European and Japanese equities. They're quite negative on emerging markets at the moment, taking the view that US dollar strength could cause problems for this area and outflows out of these markets are picking up. Confidence is very high in the US. This and the fiscal expansion may provide the means for a final leg up in the market. Okay, so next let's move on to 7IM. Ahead of US election, 7IM reduced Asia Pacific stocks and they took down their Japanese yen exposure, which has worked well. 7IM feels that Trump's win has helped value stocks return to favour, as well as gold and banks, and they've seen a sector rotation away from the bond proxy stocks. Prior to election, there was quite a risk-off sentiment with 7IM, but now they feel that the mood is more risk-on. On Brexit, they feel that they're more optimistic and we could see a softer Brexit than originally what they thought. Okay, so let's move on to UBS. So UBS remain constructive on growth, but see inflation picking up. They're discussing currency views and are considering closing out their short position in sterling. Minimum volatility equity has sold off, but they have a fundamental equity product which is called RAFI, and that's performed very well in tandem with the minimum volatility product. And that reflects current short-term thinking in markets right now. Moving on to bonds, they're very short duration at the moment, again, less sensitive to movements within interest rates. And also, UBS also hold a currency product called CARS, and that's provided uncorrelated returns over the past few months. So it's a good way to diversify within the fund range. Next, moving on to Schroders. So Schroders have actually had quite a big position in Europe, which they're currently reducing down, and they're using it as a source of cash for other ideas, and that's because they feel political risk in this area is quite significant. They're very wary around China, but what they feel is that they can't hedge this out without using bonds, which is an area that they don't like currently. As I'm sure you'll know, they've not liked the bond markets for quite some time, and their view of inflation's likely trajectory, both in the UK and especially in the US, it only reinforces this view. For equities, they're favouring value, as a lot of our managers are right now. And what they have noticed, though, is some of the more cyclical sectors, such as banks, miners and oils, have already had a strong run. Okay, so finally, I'm going to take a look at Goldman Sachs. So looking at the economic and technical indicators, Goldman's feel that commodities are improving, and that historically commodities have been a very good hedge against inflation. They're overweight UK and US equities, but are underweight gilts and high yield bonds. Cash is higher than usual, but this allows them more freedom in case they see any opportunities within markets. Okay, I'd like to thank you very much for listening in today. I'd like to wish you all a very happy Christmas and also enjoy your new year. And I look forward to speaking to you soon. Thank you very much.